Hey, Robert, it seems like the big story this week is the volatility in the markets. What can you tell us about how that's impacting the economy?
Well, Susan, I expect to get through this stock market volatility without much drag on the economy, but we're also seeing volatility in the bond market, resulting in higher interest rates. And in a way, it's really a confirmation of what we've been expecting, that interest rates are going to be rising. There's a number of factors pushing them in that direction. One is average hourly earnings coming from last Friday's jobs report. Another is central bank policy. We see the Bank of England announcing they'll start stepping up interest rates. And a third big factor would be the new budget agreement, implying that the U.S. is going to have to borrow some more money and therefore increase the supply of bonds out there and pushing down prices and pushing up yields. So there's a lot of math right now that's sort of working together to suggest that interest rates will be rising, as we've been expecting for a long time. But now is we're getting to the point where we don't have to say we're expecting it because it's happening.
So let's talk a little bit more about the budget. And there's so much to dissect, obviously, in the budget, but just to stick to the highlights that you mentioned today in your report, federal defense and non-defense spending is going to be boosted by $300 billion with an extra $90 billion for federal disaster. Now, those numbers, obviously, they seem huge, but how will they impact the overall economy?
They're going to increase the budget deficit, and importantly, they're going to increase it relative to the size of the economy. We like to scale this, the budget deficit scaled to the size of gross domestic product. That starts to increase. It implies that we have to, as I said, issue more bonds in the future to pay for this. We have to borrow the money to pay for that. And that in and of itself will tend to push interest rates up a little bit.
All right, let's move on to mortgage rates. You also mentioned in your report that the rate for the 30-year fixed rate mortgage increased this week. What do you think the effect of that could be on housing?
I think there's a segment of the housing market that's vulnerable here, and that's the new home owners, the millennials trying to get into the housing market. And they're facing an uphill battle right now, because I expect to see more upward pressure on mortgage interest rates going further ahead. And so the affordability of housing due to higher interest rates and higher prices starts to come down, which means we're getting less and less for our money going forward.